Good morning, everyone, and welcome to the Sirius Report. Well, Paul, there is more and more data emerging of the $350 trillion time bomb that will ultimately take down the Western financial system.
Yeah, absolutely. And this is something that has been ongoing for quite a long time. And it largely relates to an increase in interest rates, which we saw obviously when they started to hike them from 0% to nearly 5%. And there are many facets within the financial system where this should have been a far bigger problem than it actually is. And part of that relates to when we had huge problems when unrealized losses in the medium or small medium regional banks in the US transpired. So SVB went to the wall because its unrealized losses became realized. And one aspect of this is those enormous unrealized losses growing, and there's still a huge problem that has never been rectified and won't be rectified. But like anything else, it's just another straw that can break the proverbial camel's back. And that's just an initial point worth mentioning in this regard, because there are many facets to this huge problem that can't be dealt with. I mean, the only way effectively to deal with this is you would have to have huge insolvency events in the financial system. And of course, they can't allow that to happen. And I'm not suggesting they should do, but that's just a sort of an initial statement with regards to financial institutions with unrealized losses. And there is what we call the banking system, but then there's this enormous opaque shadow banking system where arguably there are far greater problems in some aspects of the financial system that exist than in the traditional banking system.
Yeah, it's kind of fascinating because while the numbers and certain things may be relative, I mean, gosh, if you remember the movie The Big Short, they talked about $15 billion in losses. And yet now, just 15 years later, this is now in the trillions, and they speak of trillions as if it's just a drop in the bucket. For example, 2008 subprime crisis, there was $1.3 trillion in bad loans. So far in 2024, and this is just some of the data up to that point, private equity bubble is now 3.8 trillion in leveraged debt, which is four times bigger, and it's of course set to implode. The other thing that to take into consideration is that in 2008 they offloaded the bad mortgages to retail investors, and as a matter of fact, we even had China come in and help save that part of the system. But now they're doing the same thing in 2024, but the banks are dumping their toxic debt into hedge funds, or I mean, I'm sorry, pension funds. And I was reminded of something that even the Trump administration was talking about wanting to do is get the pension funds to start buying into cryptocurrency and buying into other stuff. So you can see that they're trying to offload this stuff within the financialization that they've created, and they're trying to find, I don't want to call them willing buyers, but probably suckers to try to keep these um, hedge funds and these banks solvent, and it's just kicking the can down the road continuously.
Yeah, and with regards to leveraged finance, this all came about because traditional banks didn't want to get involved in lending anymore. And therefore, all these private equity funds, it came out of nowhere. They're managing trillions and trillions of dollars in assets, but there's literally no regulatory oversight. And therefore, there's unknown risks. Regulators are totally indecisive about dealing with all this hidden leverage that is hugely a problem going forward. And you also have to look at the fact that the hedge fund sector now manages globally somewhere about 5 trillion. Assets are growing over 10% a year. It's up nearly 60% over the past decade. Again, no regulation or very limited, and funds are quite often leveraged 10, 20, 30, 40 fold. So if trades go sour, then the huge risk is you're going to have catastrophic consequences. So if you have leverage finance growing at these alarming rates, and it's hidden, particularly within hedge funds, private equity firms, money market funds. The concern is not only how much leverage exists, but also how opaque it is. So regulators, investors, institutions don't know the scale of the problem, where the exposure lies. And hedge funds, of course, are often involved in very complex, highly leveraged positions, but also in markets like US Treasuries, in derivatives markets, in interest rate swaps. Interest rate swaps is a huge market, hundreds of trillions of dollars, which after they raised interest rates, after having zero interest rates effectively for over a decade, and then suddenly raising interest rates, those interest rate swap markets should have blown up. They didn't. What was done to prevent that? What band-aid was put on an enormous problem? And that's something, again, we have no visibility of. But when you have a lack of transparency, then you can have huge numbers of margin calls happening, say, on a hedge fund. Then you could start triggering enormous amounts of forced asset sales, causing huge problems in the market. And everything's interconnected financially in terms of entities. So people will sit there and go, oh, well, just a single entity failing isn't systemic. Well, it might not be, but equally it could be. And then you get all these secondary ripple effects happening. And then it could impact critical institutions, lead to broader contagion. And as is always the case, and I can speak personally from experience with regards to 2008, when I highlighted what the risks were, people didn't believe it. Risks were totally underestimated. No one believed it was remotely possible that these institutions could blow up, and therefore everyone was complacent and ignored the enormous amounts of risk that were building up in the system. And another aspect to this is so-called family offices. Do people realize they manage trillions of dollars of assets with, again, no oversight? So again, you have hidden leverage that poses this huge unquantifiable threat to Western financial stability. And regulators need to be looking at this and dealing with it. And of course, to some extent they are. But again, it's all, oh, well, manana, we'll look at this next week, next year. Oh, it's not really as big a problem as we think it is. But you could have a fairly, what would deem to be a pretty insignificant event. It can trigger a chain reaction. It can then draw in, who knows, dozens, hundreds of leveraged financial institutions, and then you have this massive contagion problem, and then the Western financial system will become engulfed by that. And what makes this even worse is the Trump administration's pushing for all this deregulation. That further empowers very risky financial behavior. That will include hedge funds, private equity, family offices, money market funds who operate with minimal oversight anyway. And therefore, this enormous hidden leverage that we recognize, and odd other people do, but most don't, is a key risk that will, absolutely will at some point trigger another financial crisis. It's an inevitability. It's rather like knowing something was going to happen in 2006, but you couldn't say when. It's not time driven, it's event driven, but eventually something is going to happen that then is going to cause this huge problem in the financial system. And of course, whereas it was just a subprime crisis in inverted commas that caused 2008, now it's an everything crisis. So when we use the figure of 350 trillion, when you look at it tied to leverage loans, interest rate swaps, mortgages, derivatives, other broader derivatives trade, etc. 350 trillion is not an exaggeration, and we've been hiking interest rate. How much of this leverage hangs over from the days of zero interest rate policy? It absolutely does. And that's why it's incredible from my perspective that they've been able to raise interest rates the way they have. And we haven't seen far more serious problems rearing its ugly head in the broader financial system. And of course, I'm not excluding the so-called too big to fail banks or any of those from this equation either, because they have huge uh, amounts of, say, interest rate swaps, for example, or other exotic derivatives. But this is something you can attribute, obviously, to hedge funds as well. So this is why, in a very broad sense, what we're discussing is an absolutely real problem. But you don't hear people talking about it because a lot of people in the financial or the so-called social media, FinTwit, FinX world don't know this because most of them, or not most of them, but too many of them, don't actually have any understanding of the inherent risks that exist in the Western financial system. And this is why I think, it's an extremely important subject to discuss. And obviously, there's the subprime crisis that never went away, and I think you've got some stuff you want to talk about with respect to that as well, Ken.
Yeah, and I think that one of the most important things we want to emphasize here is we're not predicting a date. It's impossible to do this. Let's go back to 2023 when you had the banking crisis, Silicon Valley Bank, First Bank of Republic. They happened overnight. There were signals. The key thing is just like in 2000, 2008, there were signs and signals that only a few were paying attention to. And the business media, the government, none of them were coming out and even giving warnings about what was going on. They just simply wanted to keep the status quo going, the gravy train going, and eventually you had this collapse, and they stand back and like give this shock look. "Oh, we never saw it coming." Yellen said that. Bernanke said that, etc. So the important thing is to take a look at all the different signs and signals that are happening. One, it's much more difficult these days, just as you alluded to, because the primary conduit for all of this is the $1 trillion shadow banking lending system. It's not being done by the primary big banks anymore. Those banks are lending to shadow banks, which then lend to the hedge funds and all these others, and they're doing these this buying and this leverage loans, and it's so opaque. Nobody really knows what's going on there. That it's the underlying thing that could cause anything in an instant. Let me give a great example. In 2009, the U.S. government was barely underwriting student loans through Sallie Mae and such, or underwriting home buying mortgages through Fannie Mae. Now, all of a sudden, in 2009, when the Obama administration took that completely in and gave student loans to everybody, underwrote that, it's now 15 years later. Trump administration is forcing all of these uh, borrowers to have to pay in just a short amount of time. The default rates on that is up to 20%. So FHA now comes out and says if you are in default of your student loan, you can't get a mortgage. And it's happening at a time when we're getting a proliferation of homes that are on the market. There's no buyers, and for the first time since like 2020, prices are going down. You're starting to see all these little things come into a point where the dominoes are just going to continue, and all of these are underlying the derivatives that are a quadrillion-dollar market that are tied intrinsically to all of these different dominoes.
Yeah, and the big problem with the subprime crisis is because it never went away. I mean, technically, people can end up in a situation where they fall into what you would then regard as a subprime crisis sort of territory again. They may not have been subprime when it was issued, but the situation's come about because of the deterioration in the economy, the fact that I mean, mortgage rates now are, I think, for 30 years, something like 6.8%. So it's killing the housing market in terms of new buyers. But okay, not everyone has a 30-year mortgage, and therefore that's going to be a problem. More so, I think, in Europe and places like where people take out 5-year, 10-year, or whatever mortgages and have to remortgage after that period of time. But increasingly, because of the desperate economic situation, for example, in the US, more and more people are getting sucked into that subprime territory by effectively becoming that. And the subprime market is bigger now than it's ever been. And it's only going to continue to grow. And this is because we come back to this point with financialization. The house prices have to keep rising irrespective. Because if the housing market begins to falter and house prices begin to fall 5, 10, 15, 20%, then all of a sudden you can have all these financial institutions who on their balance sheet, they're insolvent. And if they're insolvent, then technically they're obviously bankrupt, and then you start to get a contagion effect in that respect. So it is all fundamentally pinned around this idiotic idea that the Western economies are strong when asset bubbles continue to grow, and when they don't grow, we're in serious trouble. So this is what is driving house prices continually increasing in Western countries, but it gets to the point they become completely unaffordable for anyone. And this is an inevitability that we get to a point where it's impossible for people to enter the housing market. But also in the process is because interest rates have remained stubbornly high and might well do so in the future, then anyone has to remortgage or sells a property. I don't know how it works in the US, but in a lot of countries, when you buy a new house, you can't take the old mortgage with you. So it's going to constrain a lot of people to not sell their houses. And it just creates, and then when the economy weakens and people lose their jobs, then all of a sudden they're going to start defaulting on their mortgage. And then we're going to naturally see this situation where the housing market's so overheated, then prices are going to start correcting. And then we're going to start to see situations where the subprime crisis becomes a real problem again. And it's not something they think they can continue to kick the can down the road, pretend it's not a problem, and imagine that somehow it's all going to come out in the wash at the end and we're going to manage this. The things we're discussing are bubbles that are getting bigger and bigger and bigger, and there's new sectors all the time that are just growing exponentially, and the problems are growing exponentially. And with regards to the financing, Ken, I'd also make the point no one really knows what is financing, where all the money is coming from to some extent. That raises some serious questions as to what's financing all this equity that apparently exists in hedge funds, etc., and money market funds. It's very debatable. I mean, so it might include, yeah, of course, traditional banks, but traditional banks have been making a point of not wanting to lend because they don't like the environment. They don't trust it. They're basically telling us it's not an environment you want to lend in because it's fraught with enormous risks. And the risk also is just the broader weakening of the economy itself. So when we talk about 350 trillion, it's not an exaggeration. If you start adding all the sectors up and all the derivatives that are involved, 350 trillion is not an exaggeration, but also a lot of it is fueled by this hike in interest rates. And those interest rates are not lowering. And in fact, we've seen what's happened with Trump tariff policy with the 10-year and the 30-year that remain stubbornly high. And they might continue to rise. And therefore, for example, when the US has to come to refinancing very shortly $6 trillion worth of debt, and that has another problem that will create in the sense that interest rates interest rates, or sorry, the interest you pay on that debt will rise. But also, if interest rates remain high, everything's predicated on endless credit. Well, endless credit gets more and more and more expensive. And then we've got all the institutions bailed out with endless credit when they're insolvent. I mean, we're allowing insolvent businesses to be bailed out with credit to kick the can down the road, to stop them going bust today. But maybe they'll go bust tomorrow, next week, or in 5 years' time. That's why this problem isn't going away. And it's why debt does matter. And the idea, well, it's irrelevant, what's another 50 trillion, 10 trillion? Well, it does matter. And it's reaching the point where these bubbles are so huge and they've transferred the risk to a sectors they have no visibility of, rather like euro dollar. No one knows anything about it. No one knows who's involved, what the counterparty risk is, etc. It's just this huge black hole that finances who knows what. And we've increasingly allowed this to happen in, just for example, in the United States is one example of this. And a lot of this problem resides not just in the US, but in other Western countries. And it's something that is not discussed very often because it's not well understood. That financialization is always where you create this myth that institutions are solvent, when in fact, if you strip away the veneer and look at the reality, there's enormous amounts of financial institutions who are insolvent, as are hedge funds, etc. But as long as their balance sheet looks healthy, the world's okay. Well, the world isn't okay because in the process, the real economy is getting weaker and weaker. And at some point, the real economy is going to consume financialization. And then if you want a time frame, and that's not a time frame, that's an event, that driven scenario, that's when the house of cards comes down in totality. And this is an inevitability. It's just not a question of if, it's a question of when. And if we knew when precisely, then we'd be extremely rich in the process. Because no one does like me in 2006 knowing what was going to happen, didn't tell me when it was going to happen, but you knew it was an inevitability, and it's the same now.
Exactly. One of the great examples of that was I was watching a business network, and they had the CEO of Lehman on, and he told outright it was a Wednesday. Yeah, we have $26 billion. We're well. We have enough liquidity. We're well to go. And then, of course, another individual on that network came out and was telling people, "Don't sell Bear Stearns. Don't sell Bear Stearns." By that Saturday, both of them were pretty much gone forever in their forms in just 3 days. So they're not going to promote when something is going to collapse. They're going to be saying up to the final minute, stay in it and be the sucker while everybody else who has the knowledge of what's happening is getting out through the door. But the last thing I want to do is lay out two examples of something of where, just to give an idea, because, a lot of this can be dry, a lot of this can be just really convoluted to try to get through. But a global ratings agency back in late April spoke about the leveraged finance default rates and that they are increasing. They expect 2025 default rates of 5 to 5.5% for high yield bonds and leveraged loans. And then, of course, you have where default and the leveraged loan default rate could rise to 1.75% from currently 1.23%. Now, if you think about it, it's half a percent. Okay. But when it's half a percent on potentially $350 trillion, that is a complete wipeout of the entire financial system for both Europe and the United States, just half a percent. And it's not going to be rolled over. So the question is, how many more suckers can they get to buy this stuff to keep it going. Well, we see what they're moving into. We're seeing them move into crypto. We're seeing them move into other things. They're trying to get the pension funds. They're trying to find that sucker to keep the things going as the defaults really start to accelerate.
Yeah, and well, and that's the point, and this is why everyone moving out the US dollar and US treasuries is a big thing. People moving huge sums of money out of the United States and elsewhere is a big thing because it starts to weaken uh, the areas that are already extremely weak and vulnerable. And therefore, that's why everything is interconnected, why it's extremely important. And yes, it may seem dry. And yes, there are a lot of people who have told people repeatedly, "Oh, it's going to blow up today. It's tomorrow. No, it's next week," and that's extremely unhelpful because it's
Yep.
giving people this impression, well, it hasn't happened, so it's not going to happen. Well, it's an inevitability. It will happen. The extent of what the problem will be is difficult to quantify. We're not saying all $350 trillion goes to the wall. That's absolutely not the case. But you only need, as you point out, Ken, a relatively small percentage. And then it's an extremely different situation altogether. And that's why we're making this point. And it's something, the comment we made, you don't hear people talking about. They don't mention it. They don't quantify it in the terms we have to try and emphasize why this is a real problem. But what you can say is that the whole US Treasury, US dollar complex, and the lack of trust in it, that it's not a safe haven, and as it once was perceived, is a huge problem in a broader sense for that Western financial system. And because, once you start to get capital outflows, then a trickle can become a torrent. And when a torrent, then it starts to fundamentally undermine the financial system in a broader sense. And, it's difficult to say what can be the straw that does break the camel's back, what could constitute a Lehman moment in the future. But the mere fact of having a 30-year, if it stubbornly stays over 5%, if the 10-year gets anywhere near 5%, are just two examples where it's absolutely clear that if that persists, you're going to start to create massive structural problems in the United States, for example, which is why they backtracked from implementing tariffs, hoping, oh, well, that will cure the problem with the yield curve. It hasn't in any way, shape, or form. But that's one of those things where you're being given clear evidence of just two reasons why you can suddenly have huge structural problems. And that's just a 10-year and a 30-year yield. There are dozens, hundreds of other examples of where if something happens in a certain way, then that point of weakness can become a contagion problem and then cause a massive financial crisis. And bear in mind, it's an everything crisis now. 2008 wrecked everything, not just subprime. And therefore there are many other factors and facets to this problem than ever existed in the past in 2008.
Exactly. Back in 2008, 8% default in mortgages led to the collapse that took place then. We're already seen at 5 to 5.5% on a leveraged loan system that is multitudes, tens, if not 100 times bigger than what that was in 2008. So we'll definitely be here to keep you guys updated on what we find and lay out the data. Paul, were there any other points you wanted to make here in this
No, I think
podcast?
that's enough. We could talk about this for about 10 hours, but half an hour is more than
Absolutely.
enough.
To everybody here at the Sirius Report community, as always, thank you for your support. Don't forget to like, share, subscribe, comment. Send this out to anybody you think it might be important to. And until the next time we get together, have a great day.